Bitcoin is now about 3 trillion, pushing 4 trillion in assets. That would argue that Bitcoin is about a 3% allocation compared to stocks and bonds.
For years, financial advisors have had a cautious, even skeptical view of Bitcoin and other cryptocurrencies. They've warned clients to stay away, citing extreme volatility, a lack of regulation, and the risk of a government ban. As a result, many advisors feel they've lost credibility with their clients as crypto has surged in value. But Ric Edelman says this fear is misplaced. He argues that advisors should not be afraid to admit their past caution was, in fact, prudent. At the time, with regulatory uncertainty and potential government crackdowns looming, advising clients against a risky asset was the responsible, fiduciary thing to do. The facts at the time justified that position.
I lose credibility, I harm my reputation, and advisors are scared about that. So it's easier to stick with the old message of, I'm going to continue to say, don't buy it. And they'll say that as Bitcoin hits 1 million. So here's the answer to that dilemma. Here's the thing. Instead of being fearful that you were wrong to tell the client at 50 not to buy, acknowledge that you were right. You were prudent. At the end of the day, you're a fiduciary. You care first and foremost about safety and security for your client. You want to know that their financial future is secure. And if you go back to when Bitcoin was 20,000 or 40 or 60,000, heck, just go back 2 years ago. We didn't even know who was going to win the election 2 years ago. We really didn't know if Kamala was going to beat Trump. Money was even money at best, and some argued she was going to win. And we knew that if Kamala won the election, Bitcoin would be dead because she would preserve the Biden-Gensler regime and their attitude about crypto. Well, who would want to buy Bitcoin in that kind of a scenario? So you were being prudent to your client based on the facts at the moment. Well, fast forward to 2025, and the facts have changed. We now have the Trump administration, which wants to make crypto the focus on the planet here in the US. We know that every member of the president's cabinet personally owns Bitcoin, that all the economic appointees are strongly supportive, that a majority of both parties in the House and Senate strongly favor it. We're seeing legislation for the first time. And as a result of the clarity of regulatory and legislative processes, we're now seeing institutional engagement in a way we've never seen before. And we're only at the very beginning of this, which means due to the new set of facts, we no longer have to worry, is Bitcoin going to be banned by government? Is it bad for the planet? Is it only being used for nefarious, illicit, illegal activities? All of those questions have been resolved, which means now that we know the facts, we know that Amazon is here to stay predominantly as a cloud services provider. We don't have to wonder in 1999, is anybody going to buy books online? It's a different set of facts. So while nobody bought Amazon in 99, every stock portfolio owns Amazon today because the facts have changed. Similarly, that's the case for Bitcoin and other dominant crypto assets, which means you can say to your client, prudently, confidently, legitimately, as a fiduciary, I told you not to do it before because the risk was too high. The risks have largely been diminished, and we can confidently engage in this asset class because it is now mainstream with full government support. The aggressive, I would take the initiative. I would definitely engage in the conversation to say, hey, I've been telling you for the past number of years that Bitcoin was too risky to be a legitimate exposure in your portfolio. The facts have changed. And as a result, my analysis has reached a new conclusion. That's my job for you as an advisor, is to constantly monitor the markets, to evaluate what's going on, to determine if what you have been doing is what you ought to continue to be doing. And what I have concluded is that we now need to reevaluate and reposition the notion of Bitcoin in a portfolio. It's no different than your mortgage. At a given moment in time, I would tell you to refinance your mortgage. Why? Interest rates have changed. Mm-hmm. Well, why did I tell you to buy that mortgage when interest rates were so much higher 5 years ago? Mm-hmm. Because that's the way it was, and that was the best deal at the time. The deal's gotten better. Now you ought to refinance. Does that mean I'm saying I made a mistake telling you to buy when interest rates were higher? No. The circumstances have changed. The environment has changed. And as a result, a new opportunity has emerged. So do I borrow money to do it? I mean, and people are just overcomplicating it. It's really very simple. Most advisors today build passively managed, diversified portfolios. They're not trying to beat the market. They're trying to be the market, right? I just simply, if the stock market is 60 trillion in assets, which it is in the US, and the bond market is about 40 trillion in assets, it's worth about 100 trillion, 110 trillion in those two assets. That's the weighting I'm going to give my portfolio because I'm passively focused. Bitcoin is now about 3 trillion, pushing 4 trillion in assets. That would argue that Bitcoin is about a 3% allocation compared to stocks and bonds, which means if you truly believe in passively owning the market, you ought to have 3 or 4% allocated to crypto. If you don't do that, you're essentially saying that you don't believe in it, you think it's going to fall, and that means you're effectively shorting. And that's an active management decision. You don't short any other asset. Why are you shorting Bitcoin? And why are you making an active call? You're doing it by accident. You're doing it inadvertently because you haven't really thought it through. So the simplest answer is that everybody pretty much should have a 3 or 4% allocation to Bitcoin. If you want to make a more assertive, active focused decision, you would increase the allocation beyond 3 on the basis that most are projecting that Bitcoin will continue to outperform all the other asset classes for the next 5 years. And that would argue for an increased overweighted allocation, which is one of my premises. But even if you toss that aside and you want to remain passively focused as a diversifier, you should have a 3 to 4% allocation. Where does it come from? It's real simple. You own Bitcoin the way you own IBM. You're not lending to IBM. You're not buying an IBM bond. You're owning it as a stock. That's an ownership asset. You're owning Bitcoin as an asset. That means it comes from your equity sleeve. So if you're 60-40, for example, you would now become 57, 40, and 3.
Together, this represents about $100 trillion in assets. Bitcoin, with a market capitalization of around $4 trillion, now represents roughly 3.44% of that combined total. Therefore, a truly passive, market-weighted portfolio should have a 3 to 4% allocation to crypto. An advisor who neglects to add this allocation is essentially making an active management decision to short crypto.
Something that kind of most people have missed. You didn't miss it, but most people did, and that is the longevity argument. We are living longer than ever before. I've been in the aging field for many decades. I was on the advisory boards of Stanford's Center on Longevity, the Milken Institute's Center for the Study of Aging, MIT's Age Lab I've worked with. And all the scientists in the study of aging and longevity are pretty much in agreement that if you're alive in 2030, forget about your age, if you're alive in 2030, odds are good you'll live to age 100 and beyond. We, thanks to medical advances, innovations, AI, robotics, 3D printing, big data, nanotech, biotech, bioinformatics, for all of these medical advances, we are rapidly curing the leading causes of death, as we've been doing for the past couple of 100 years. 100 years ago, syphilis and pyaemia were 2 of the 5 leading causes of death in America.
Most people never even heard of them. Yep.
Exactly. 50, 75 years ago, tuberculosis was the leading cause of death. We wiped that out. Cholera was the leading cause of death. Today, it's heart disease, respiratory illness, cancer, diabetes, obesity. We're rapidly curing all this stuff. It's being way overweight that's creating these illnesses. And we're figuring it all out. And over the next 20, 30 years, we're going to cure all that stuff. We'll have new things that kill us, but these will be gone. And it's contributing along with we're not smoking like our parents or drinking like them. We have better exercise, lower stress, better relationships. All of that is contributing to our longevity in an unprecedented level, meaning you're going to live really long, which our society isn't used to because it's never happened before, nor has our economic model. The notion of retiring at 65, living to 85, that works. But if you retire at 65 and you live to 105, is your money going to last as long as you do? The answer is, for most Americans, no, which means 2 things. Number one, you're probably gonna have to work longer than 65. Retirement is a 20th century innovation that won't exist in the 21st century, partly because you'll be bored to death, but largely because you need the money. Second, you need to get your money growing to offset taxes and inflation. And inflation's the key. We all know the debasement of the currency because of inflation. We know of monetary policy. We see our federal deficit and the federal debt. We know that overabundance of cash is death for asset growth and development. So we need to shift. And that means the 60-40 is dead. We need to go to 80-20. You need to not only have more in equities, you need to hold them longer than ever. Instead of that glide path that has you reducing equities in your 60s and 70s, you need to hold 80% of your portfolio in equities into your 80s and 90s. That's revolutionary. It's unprecedented. Most advisors are unfamiliar with this. And if you're going to have 80% of your money in equities, a 10% crypto as part of the 80, that's not a big deal. And here's the real problem that most of us don't know, Anthony, is that, I've been in this business since 1986, and I'm one of the old farts in this industry. Most advisors have been doing this, like me, for 30 or 40 years or less, which means our personal experience starts somewhere in the 1980s or 1990s, meaning we haven't done a lot of studying of financial history from the 50s, 60s, 70s. We don't pay a lot of attention to the 1970s when we had double-digit inflation. We had 18% mortgage rates, 15% inflation. We had oil embargo where you can only buy gas every other day of the week, limited to 5 gallons. We don't remember that stuff because we didn't live it. We were teenagers at best, not even born for many of us. And we pay attention to our adult life. For me, it was graduating college in 1980, the Reagan Revolution. Interest rates in 1982 peaked. And from 1982, we're talking 50 plus years, from 1982 to the present, interest rates have generally done only one thing. They've gone down. We went from 18% down at one point to near zero. We all know that as interest rates go down, the value of bonds goes up. So think about this. You were able to buy a bond with a 12% coupon and the bond rose in value.
Amazing.
Why wouldn't you have 40% of your money in that as a safeguard against equities? Mm-hmm. This is why everybody had the mantra you just mentioned. You should have a lot of bonds. And people have begun to believe this is how bonds always work. The answer is no. This is how bonds work in a declining rate environment. But look at today's economy, look at today's budget crisis, look at today's macroeconomic scenario. Bond interest rates are very low today relative to the 70s. Although there's talk of them being cut by 75 basis points? I mean, nobody's talking about interest rates going to 2 or to 0. Odds are, due to the economic crisis in our country, due to the fiscal problems, odds are high over the next decade that rates will go up, not down. And if rates go up, bonds lose value. If rates go from 4 to 6, bonds will lose 50% of their value. In that scenario, why would you want to have 40% of your money in bonds? It makes no sense, which further argues for an increase in your equity allocation. I'd much rather have a stock with a 4% dividend than a bond with a 4% coupon. Clearly make a case for not having much, if any, with one primary purpose, and that's liquidity. Mm-hmm. If you need access to cash, we always argue there's going to be a market downturn at some point that could last 20 or 30% and a couple of years, and you need money to survive, pay your bills, live your life. If you lose your job or have a major medical crisis or a kid's got to get bailed out of jail or get into rehab, you need cash. So have enough cash reserves so that you don't have to sell your other assets while they may be low in price. Mm-hmm. That's the only reason to maintain cash, as a cushion for liquidity purposes. Beyond that need, there's absolutely no justification.
This strategy was born from the financial environment of the last 40 years, where interest rates have steadily declined. From a peak of 18% in the early 1980s to near zero, bonds have performed incredibly well. A high-yield bond not only paid a generous coupon, but also increased in value as rates fell. This created a generation of investors and advisors who believe bonds are a guaranteed safeguard against equity downturns. But Edelman warns this is a dangerous misconception. Given today's fiscal landscape, with massive government debt and an inflationary environment, the era of declining interest rates is over. In fact, rates are more likely to rise than fall over the next decade. If interest rates rise, bonds lose value. Edelman notes that if rates went from 4% to 6%, a typical bond portfolio could lose half its value.